Hello and welcome to CommBank View Economics and Markets. My name is Mandy Drury and I'm always absolutely delighted to be your weekly podcast host. But of course, I'm not the only one on this show. I'm joined by CommBank strategists and economists. And today I am joined by Dennis Voznesenski, who is the agricultural and sustainability economist at CommBank. So welcome, Dennis. Great to have you with us today.
Thank you so much, Mandy.
So the Strait of Hormuz is effectively closed, right? And we've certainly seen that the normal flow of traffic has been affected, which among many other things has affected a significant proportion of the world's flow of fertiliser. We've seen fertiliser prices spiking, and if the closure persists, the problem may shift to a problem of availability. Tell us how the closure of the Strait of Hormuz is affecting agriculture in Australia.
Well, look, apart from a lot of hard work, rainfall, you also need a lot of fertiliser and a lot of fuel to grow crops in Australia. And also, like you were saying, a big chunk of the fertiliser globally comes from behind the Strait of Hormuz. You have over 40% of the world's urea, which is a nitrogen-based fertilizer. You need 3 fertilizers for crops to grow. You need nitrogen-based, phosphate, and potash. So nitrogen, a lot of it's stuck. Then you have phosphate. Around 15% of the world's phosphate is stuck behind the Strait of Hormuz as well. And the interesting thing is, it's not only a primary direct impact of literally not getting the fertilizer out, but then the core ingredients other regions need to produce fertilizer as well is also stuck. So a fifth of the world's natural gas comes from the Strait of Hormuz. Countries in Asia need that gas to produce urea that they also send to Australia. And with phosphate, around 40% of the world's sulfur, which is needed to create phosphate, also stuck behind the Strait of Hormuz. So it's a big problem.
It certainly puts our farmers in the direct firing line, doesn't it? So maybe you can just quantify it for us. Give us some numbers here. How much have farm input costs like fertiliser and diesel risen since the start of the war?
Well, it's been very volatile. So if you take urea, it peaked at 70% above the 27th of February, beginning of the war. Now it's probably around 60% compared to 70% before. If we look at the terminal gate price of diesel around Australia, right now it's probably around 25% higher than it was at the beginning of the war. But at one point it peaked at 90% above the beginning of the war. So you're having the profit margins of farmers squeezed because their costs keep going up.
Look, Dennis, at the moment in the news, there's talk of a peace deal, chatter of a peace deal between the US and Iran. And let's be honest, we've been here before. There's quite often chatter of a peace deal. But if the war in Iran ended tomorrow, if the Strait of Hormuz started to open up to the normal flow of trade and traffic, what would we see in terms of the lag time before it eased up things on the fertiliser and grain price side?
Well, you can't instantly get fertiliser from the Middle East and just pop it over in Australia. It takes probably 3 to 4 weeks for that ship to leave behind the Strait of Hormuz and actually come to, say, the port of Geelong and offload. And then that has to get to farmers up country as well. So it's not instant. It'll probably take 3 to 4 weeks for that fertilizer to get here. And to be honest, right now, this next 1 to 2 weeks is pretty critical, because if the Strait can be opened over the next 1 to 2 weeks, that fertilizer will get here in time for around mid-July. And that's when farmers will really be at the critical point of needing that fertilizer.
One of my biggest questions is how has Australia's agricultural sector allowed itself to become so vulnerable to such offshore supply disruptions?
Well, that's right. The majority of our fertilizer actually comes from overseas. So around 100%. So everything we need from a urea, nitrogen perspective comes from overseas. For potash, it's also around 100%. We produce some phosphate locally, but it's relatively limited. And it's because in the past, we really focused, like in many industries, including in refining of fuel, on the economic side of things. And then national security and food security, that was secondary. And the geopolitical environment that we have now entered is obviously very different to what we saw 5 to 10 years ago. There's a lot more volatility. There's a much higher chance of disruption to supply chains. And now the mentality is switching. And we are actually building facilities to produce that fertilizer locally. So in Western Australia, we're building both potash and urea-based facilities for fertilizer over the next 1 to 3 years. A lot of that will be coming online. We're not going to be fully self-sufficient, but at least we'll have some of that production on the local front. So things are changing.
What about grain prices? Have they risen to compensate for the profit margin of farmers?
Well, they have risen, but nowhere near as much as the cost of producing those same crops. So if you look at wheat prices, they're up around 13% on average across the country since the 27th of February. Barley up around 15% and canola 8%. So those are the 3 of the probably 5 key broadacre crops that we grow in Australia. I'm talking about grains and oilseeds. We'll leave cotton to one side for the moment. So they have gone up. not anywhere near as much as the cost of producing them. And what's important to note is that it's also been partly just due to the weather. So it's been dry on the east coast of Australia. It's been dry in the US, incredibly dry. And that's pushed prices up overseas and ours as well.
What actually is the situation with the profit margin of farmers at the moment?
Well, imagine if you had any business and you had costs go up anywhere from 20 to 60%, and your revenue only went up 8 to 15%, they would be squeezed considerably. Now, some farmers can put off the application of fertilizer until later. So say they see the price of fertilizer up 60% and they go, you know what, maybe I'll just wait till July, August. Maybe the situation with the Strait of Hormuz will improve, more fertilizer will come in, prices will come down, and I'll actually get I'll be able to pay a lower price. So that's what a lot of the farmers are doing at the moment. And also there's in theory, if you do have a shortage of fertilizer globally, eventually does translate to higher grain prices. So while fertilizer prices are high now and grain prices are low, maybe towards year end, we have a slightly different situation because you can't just have high cost of production and no impact on the end revenue.
But maybe you can pare it back for us, because why haven't those grain prices risen more due to the Iran war, considering that they almost doubled, right, when we saw Russia invade Ukraine?
Well, a lot of people compare this war to when Russia invaded Ukraine, and fair enough, because it's a very large and important event from a geopolitical perspective. However, Russia and Ukraine accounted for 20 to 30% of all the wheat exports in the world. So imagine 1 out of every 3 tons that got exported to any country, that was exported from the region. So when the war started, prices literally doubled in a span of a couple of weeks. Whereas with the war in Iran, Iran's not an exporter of grain. If anything, it's a net importer, 2 to 3 million tons depending on the year. And the Middle East, even more broadly, is also an importer. So you don't have any export market that has been impacted by the conflict. It's only been importers. And the second point is you then move to the next argument and you would go, well, if fertilizer is disrupted, it will impact production, and then that should lead to higher prices. But that just takes time. That's the first thing. And secondly, most of the wheat crop that we produce globally is grown in the Northern Hemisphere, and they already planted part of their crop at the end of last year. They already purchased some of their fertilizer, so they're less impacted than we would be here.
What about when you take a look at, agriculture is a very vast umbrella. There's all kinds of areas within agriculture. Which sectors in particular do you see as being affected by the Iran war?
Well, from an absolute volume perspective, in terms of who uses the most urea, so nitrogen fertilizer, who uses the most fuel, it is broadacre cropping. So think wheat, barley, canola, pulses, sorghum, those sorts of crops. So 60% of the whole volume of urea that we import and use in Australia is for cropping. It's not to say that other sectors aren't impacted. They also are. Cattle could be, dairy could be, beef cattle could be, because you need fertilizer for pastures, improve the pasture growth. However, they can wait a little bit to use that. It's not critical that they need that. Whereas with cropping farmers, if they don't use fertilizer at the right points of time, they will impact how much they grow per hectare and eventually the quality of the grain as well. So for wheat, if you don't fertilize enough between planting, which is around April, and then September flowering, you impact how many tons per hectare you can grow. And after September flowering, you impact the quality of the wheat. So instead of growing wheat for sourdough, it's a very high quality wheat, you'll grow wheat only good for feed purposes.
Talking of feed purposes, and you mentioned cattle there, what exactly are we seeing in terms of the impact on beef prices? Because I've just come back from the United States, where it's rather pricey to go out for a steak dinner now. In fact, I believe beef prices there are at record highs. That's
right. So US prices are at record highs, and there's a couple of factors behind it. The biggest one being, on the supply side, the US cattle herd is at a 7-decade low. And on the demand side, US consumers are eating more beef than ever before. And at those elevated beef prices, you may think, well, if the Strait of Hormuz remains closed and you have really high oil prices, eventually that could translate into reduced consumers' ability to spend, because you have to use more to fill up your car, for example. So you have less money to spend on things like beef. So that is the impact of the Strait of Hormuz. But right now in the beef space, there's I would say, even bigger factors at play, including that drought in the US and their ability to source from different countries, which has been changing as well.
Is it because of the drought in the US that we're seeing those herd sizes at 7-decade lows?
So we have seen seen very considerable drought conditions over the last few years, and there's been a liquidation of the cattle herd. Last year, the stars literally aligned for Australian cattle prices, because not only was there insufficient cattle inside the US to slaughter and produce into beef, but the US couldn't source from Mexico anymore because of a flesh-eating parasite that went through their cattle. So they had to close the border to 1.5 million head of cattle that typically cross the border into the US. They couldn't import from Brazil due to the tariffs. They made it prohibitive. So a lot of the beef just came from Australia. It's pretty phenomenal. Now those factors have started to change. So Brazil is exporting to the US. The US is the demand for our beef isn't as strong, but it's still quite good.
How do our herd sizes compare here in Australia? Because we're certainly a country that, depending on which location you're looking at any given time, there's quite often a drought.
Well, that's absolutely right. So I was traveling through Victoria and South Australia last year, and then at the beginning of this year, for a while, they were in herd liquidation because it was just far too dry in South Australia and Victoria. So they were sending cattle to slaughter. Then it finally rained around Christmas, New Year's, early January, and now farmers are rebuilding their herds. I was in a place called Dirranbandi in Queensland, in Roma, and there they have had the opposite. So they had very good conditions over the last couple of years, and they actually rebuilt their herd already. So it's really mixed depending on where you are in the country.
Indeed, you're quite often on the road, aren't you? You're travelling around rural Australia. I guess it's absolutely necessary to be able to do your job. When you talk to farmers around Australia, how are they changing their practices, or maybe how are they intending to change their practices as a result of the US-Iran war? And does it mean that they might be changing, for example, their 2026 cropping strategies?
Well, that's right. And I'll give you some context. So farmers plant around April to May, and then they harvest their crops, so wheat, barley, canola, pulses, towards the end of the year, so November, December. They're changing it in 3 ways. One, they are reducing how much wheat they plant because it is a nitrogen-hungry crop. They're planting more feed barley. You need less nitrogen for feed barley. They're planting pulses. Pulses actually put nitrogen back into the soils. That's the first thing. So reduced wheat area. Sometimes they are talking about just reducing how much fertilizer they use, and we already talked about the implication of that. You'll just grow less wheat and probably lower quality. And lastly, some farmers are just saying, you know what, maybe I'll just plant less in general this year and take a bit of a holiday on part of the crop. That is more anecdotal. That's not the main force at play here.
You know, getting back to the high prices for fertilizer and the possibilities for further fertilizer shortfalls, when will we noticeably, us, the consumer, when we go to the supermarket, start to notice the impact on grain prices as it pertains to flowing through to things like pasta and bread?
Well, look, firstly, it needs to flow into commodity markets, and then it flows into what we see on the shelf in supermarkets. So in terms of when is it going to flow into commodity markets? Well, I spoke to farmers, and what I had to figure out was when would it be too late to get shipments of fertilizer to actually minimize the impact on yields. And a lot of farmers said, look, we have enough for planting, April, May. We should be okay. We have all the fertilizers. We bought it before the war. The next time we really need to use fertilizer will be in July. Usually it's around June. They said we can push it back to July. We've got nutrients in the soil from last year. We should be okay. So if we get to July and so probably early to mid-July, if the fertilizer hasn't come at that point, or the prices haven't come down, because you have to remember, the fertilizer might be here, but if the prices are 2 to 3 times more expensive than they were before the war, you're still not going to use them as a farmer because you're going to be making a negative margin. So if by July, the issue with the Strait of Hormuz hasn't been solved and fertilizer prices haven't come down, that is when the market's going to go, oh, okay, there's genuinely going to be production issues in Australia. So I think at that point, that's when the market starts factoring it in. And then after that, there's probably a buffer of a couple of months where you say you're a flour miller, you're a food producer, you have some stock on hand of wheat that you're going to use first, and then you're going to move on to more expensive crops. So as we move towards year end, the longer this gets stretched out, the more of an impact it's going to have on commodity prices like wheat and eventually food as well.
Every week, of course, we do a different topic, and last week's topic was what were the outcomes and implications for Australia from the summit in Beijing between President Xi and President Trump. What do you think were the outcomes as it pertains to Australian trade and agriculture?
Yeah, that's a great question. So China is likely to buy a significant amount of US agricultural goods, assuming it follows through. So the announcement was that $17 billion US dollars of agricultural goods will be purchased by Beijing on top of their commitments to buy US soybeans already. So that may mean more US wheat, it may mean more US barley, maybe beef. There's not much beef there anyway at the moment, but it's commodities apart from soybeans. And your initial instincts may be, oh, okay, that's going to be bad for Australia because if they're buying more from the US, they may be buying less from us. But China also tends to have the strategy where in between negotiations with the US, it actually really cuts down on its purchases of agricultural commodities so that when they do negotiate, they can say, of course, we're going to buy so much of your goods, America, and it looks like a favor to the US, whereas in reality, they've just been putting off those purchases. So you have an environment before the negotiations with the US where China's just not in the market more generally, and then they're finally in the market, they're just not in the market for our goods. So having the biggest buyer in the world back buying ag commodities, even if it's not from us, might actually be good, because then whoever used to buy from the US will have to come to us during that period.
What part of our agricultural sector will benefit then?
Well, if China picks up its wheat purchases, that'll be supportive of China as a buyer more broadly, globally, and that could be supportive for us, even if indirectly. With beef, if China starts buying US beef instead of ours, probably not a positive. We'll have to wait and see. There hasn't been enough details. The $17 billion figure is quite vague for now. They haven't specified which commodities. And more importantly, the challenge is it's not in a tonnage perspective either. So with soybeans, at least we knew there was 25 million tons of soybeans that they're going to buy from the US, and they might not buy from other regions. In this case, it's $17 billion worth, so we don't quite know how that translates to tonnage and hence how that translates to trade flows, because we don't even know what commodity they're going to buy.
And we've also seen in the past that the relationship between Australia and China has affected what China buys from us in the agricultural sector. Sometimes they stop buying certain agricultural products altogether. How would you rate the relationship between Australia and the Chinese right now in terms of their willingness to keep on buying Australian agricultural products?
Well, look, I think there's two very different relationships. One is a political relationship, and then one is a trade relationship. And we think they go together, but they don't always go together, because China is the largest buyer of a lot of commodities globally. And just like there's laws of physics, there's laws of commodity sourcing. And if you physically can't get enough somewhere else, you have no choice but to come to a particular country and get, say it's canola or barley or whatever else. And we've seen this on and off on a number of trade wars that China's had, whether it's with the US or Canada or with Australia. Yes, you could have it for a certain period of time, but say China's not buying our canola and then they're only buying Canadian, and then in Canada they have a drought. Well, we're the second largest exporter of canola in the world, so there's only so many places you can go. China does have large buffers, and they can wait out for a long time. That's a very valid point, but also there's only so many places in the world you can get sufficient volumes of food.
What policy changes do you think we need here in Australia to help our agricultural sector become more self-sufficient and more resilient? In other words, able to mitigate and withstand external shocks like the one that we're in at the moment?
Well, we've already talked about the fertilizer. There are plants being constructed already, so we're starting to solve that issue at least partially. That's a positive. The fuel one's a tricky one because we don't really produce any of our own fuel in Australia, or very limited amounts of it. If we create a biofuel industry in Australia, so fuel made out of crops, so you can make it out of canola oil, you can make it out of waste products like tallow, so animal fats, we may be moving towards a direction of constructing a biofuel industry in Australia. And while it won't cover all of our fuel needs, at least our critical sectors, including agriculture, including defense, could be literally ambulances, will have some fuel if we at least produce, say, 10% of our fuel needs in Australia using biofuels.
In what time frame?
It's not something you can do tomorrow. So it will take years to actually build one, say the crushing facilities for canola, because you need to get the canola seed, crush it into oil and meal, use the vegetable oil then to put it into a biofuel refining facility and create fuel that can go into a car, because you can't just put canola oil into a car typically. So it's going to take, you name it, 2 to 5 years to actually build everything out. So with biofuels, the largest markets in the world are the US and Europe. And there, one way or another, the government supports the creation or the fostering of an industry, because biofuels are more expensive than conventional fuel. But it creates benefits. It creates a local fuel source. It reduces the emissions per, say, kilo or liter of fuel used, and it reduces how much of an exposure we have to the export market as an agricultural industry. So if we can use our canola locally instead of sending it overseas, then whether it's economic coercion or just unfavorable policies towards us, we care less about that. We can use more locally. So there's benefits to outweigh the costs.
You've mentioned canola. That's the one that you're highlighting. Is that the one that is the most effective to be the feedstock into biofuel, or are there others?
There's others. It depends what methodology you want to use. So you can use two methodologies. One is ethanol based. So you can use sugar, for example, for that. And then you have the vegetable oils and fats where you use canola oil, you can use soy oil, you can use tallow. So it really depends on which one you go with. There's sustainable aviation fuel, so plain fuel basically that you can create in a similar way. The most economically viable method I've seen globally, and when I think of economically viable, I just purely look at what plants have been built all over the world so far. It's been vegetable oil and animal fats based, but it doesn't rule out the sugar version and ethanol version as well. So there's a lot of kind of prods in the fire that the world's working on.
Oh, there's no such thing as a free lunch, right? I mean, it sounds fantastic to move to things like biofuels, but what will be the price impact, both on fuel and also on grain prices, of the upcoming government mandate that we do see green biofuels be blended into Australian fuel supplies?
Well, look, it depends on what the policy ends up being. So the policy could be that we have to import biofuel, and use it locally, wouldn't do much for fuel security in theory, or we actually have mandates to use fuel that is produced locally. The construction cost is going to differ here compared to what it is overseas. Depending on whether it's car fuel or plane fuel, it really varies how much higher the cost could be. So it could be anywhere from a couple tens of % higher to double or triple, depending on what you're making the fuel out of. So you could be trying to make airplane fuel from municipal waste, and that's going to be prohibitively expensive. But you don't need to do that. You can make it out of canola oil. And also it depends on how high prices for conventional fossil fuels are. So when the war in Iran started and prices doubled, suddenly it became a lot more viable to create sustainable aviation fuel. And you have to think, what type of environment are we actually going in globally? Are we going into a stable environment where oil prices are probably going to be stable for a prolonged period of time? Or are we going into one where there's constantly issues like Russia invading Ukraine, the Houthi rebel attacks in the Red Sea, US attacking Iran? There's so many of these things happening one after the other that eventually at one point you're going to have to go as a country, is it worthwhile not investing in biofuels and just hoping that everything's fine? Or is the cost actually beneficial? Because one day, if we don't have any fuel, I assume the cost is going to be much higher than if we support the creation of a biofuel industry. We have to do the numbers, and as a country decide that that's the direction or the place we're in now.
Dennis, before we wrap up, one of the goals of the most recent federal budget was to improve Australia's economic resilience. And given how important and vital the Australian agricultural sector is to our economy, was there anything in the budget that will help the agricultural sector resilience?
Well, there was talk about looking at the demand side of building a biofuel industry, but it was basically saying that we're working towards it. The details so far weren't fully fleshed out.
Thank you so much for joining us today. No. It's been an absolute pleasure.
Thank you.
Thank you. Before we let you go, let's get an update on some of the big events that could be moving the markets this week with John O, Sustainability and Energy Economist at CommBank. John, welcome. Thank you so much for joining us today. Inflation, very hot button topic here in Australia, important for the markets and also for politics and the RBA. What are we expecting in terms of the CPI out of Australia today?
Yeah, thanks, Mandy. So we do expect the CPI to have eased slightly to 4.3%. That's the headline terms, and that's really underpinned by the fuel excise reductions that's come into the market, and we're seeing that we expect that to flow through to lower fuel prices. When it comes to the trimmed mean, we do expect that to have increased slightly to 3.4%, and that's underpinned by higher new dwelling costs and also higher private health insurance premiums. So because of these cost pressures, we do think that in the quarter for Q2 this year, we do expect the quarterly trend mean to have increased by 1%. And it's worth mentioning, because of all these uncertainties, the biggest risk is really regarding to how the firms do pass through these costs to consumers, and that's something worth watching in the coming months.
Will we get much insight into the RBA's thinking from the speech by Carolyn Hewson?
Yeah, so on the same day in Adelaide, Carolyn Hewson will be making a speech. It will be great. The markets will be looking to see how the board's thinking has been evolving over time. But the reason why this speech is really important is she's the first non-executive member to give a public speech since the new board is established, since the RBA review. So markets will be looking to see what her policy leanings will be, and that will be a key event to watch as well.
We'll also be getting an insight into the thinking of the RBNZ across the pond from the monetary policy statement.
Yes, that's right. They're making their official cash rate decision on Wednesday. We do think that they'll keep a hold on their cash rate to 2.25%. So we do think that the committee will have a variety of views, and so we won't be surprised if there is a split in decision as well. But ultimately, in the big picture, we do think that the cash rate does need to go higher, but it's a matter of what the timing. So we think May, July, September, there's valid agreements for arguments for all three periods. But we do think that July will be the time to go because it will give enough time for the IBN to make the decision and to see how things go, and early enough so that inflation doesn't run away.
All eyes are also on the Federal Reserve over in the United States with the feeling at the moment in the markets that it could go either way. It could go towards hikes, could go towards cuts. It's the jury is out on this one. But we will be getting the Fed's favoured inflation gauge, the PCE deflator, this week.
Yes, that's right. So we expect the headline PCE deflator to accelerate to 3.9%, and that's going to be driven by higher energy prices. When it comes to the core PCE deflator, we do think that it would also increase, but at a lower rate than what we saw the previous month.
Wonderful. Thank you so much for joining us today, John O.
Thanks, Mandy.
And make sure that you follow CommBank View for your weekly analysis on what is shaping and shifting the markets out there. Thank you so much for joining us. My name is Mandy Drury, and it's been my pleasure to have been your host today. Enjoy the rest of your day.